Welcome. O.B.S Financial and the Wealth Management Store is proud to present the Canadian Emergency Wage Subsidy informational video, or News on the CEWS. Now, before we get started, let's get the legal stuff out of the way. Please note that the information contained in this presentation is for illustration purposes only and should not be construed as personal financial or taxation advice. This presentation is intended to provide general information on the COVID-19 Emergency Response Act as it is currently proposed. It is imperative that you review your eligibility in this program once the amendments have received royal assent. At this point in time, I'm going to ask that you pause the video and read our disclaimer in full. Thank you. And as always, before making any decisions, please discuss your individual situation with a qualified professional. My name is Stacy Bartel, founder and president of O.B.S Financial, O.B.S Tax, and the wealthmanagementstore.com. As part of our ongoing series of managing COVID-19, the following presentation is part one of our business edition. Today, we will be talking to our business partners and fellow business owners about the CEWS, or the Canadian Emergency Wage Subsidy Program. So, over the last couple of weeks, our business partners have asked us many questions. These questions include: who can qualify for the CEWS? How do you qualify for it? What subsidies are available? How do I apply? How do I report it on my financial statements? What about my employer contributions to CPP and EI? Is there anything available for me? What is the 10% wage subsidy, and how do I coordinate my benefits with that and the CEWS? Does this affect my work sharing programs with employment insurance? And what sort of compliance issues can we expect out of the Canada Revenue Agency? So, what type of businesses and employees qualify for the CEWS? Eligible employers for the CEWS would include Canadian taxable corporations, sole proprietorships, partnerships with eligible employees, nonprofits, and charities. Public bodies, local municipalities, crown corporations, universities, colleges, schools, and hospitals do not qualify, however. So, let's talk about corporations. The first thing to understand is a corporation is a separate legal entity unto law. Corporations may have two types of employees, so let's discuss them. The first type would be an arm's length employee. Arm's length employees are those regular employees that would be normally hired off of the street, right? Their qualifications will be based on their pre-crisis income, as raises, bonuses, and other payments that are not part of the normal compensation package that they've received in the past would not be eligible. The second type of employees would be your non-arm's length employees. Non-arm's length employees could be considered individuals connected by a blood relationship, marriage, common law partnership, or adoption to someone that has a controlling interest in the corporation. And a controlling interest could be considered by the Canada Revenue Agency as anybody having 10% or more voting shares. When you have non-arm's length employees, there are special limits and regulations. They would need to have been normally on the payroll in pre-crisis mode or prior to March 15th, and you should have a record to prove that. These employees would be limited to 75% of their pre-crisis salary, up to a maximum of $847 per week. And non-arm's length employees hired or placed on the payroll after March 15th would be excluded from this subsidy. Next, let's talk about sole proprietors. A sole proprietor is someone who adds their business or partnership income to their personal tax return, as the business is considered an extension unto themselves and has not been incorporated under federal or provincial law. Owners of these businesses are not considered employees and do not consider their earnings wages, as their profits and losses are reported fully under their tax returns. However, if they do have employees, those employees would be eligible to qualify based off of their pre-crisis income, which would be income prior to March 15th. Or if they were hired after March 15th, they would have to be considered an arm's length employee. Remember, Non-arm's length relationships between an employer and employee would be considered individuals connected by a blood relationship, marriage, common law partnership, or adoption to the sole proprietor or a partner in the non-incorporated business. So, what makes an employee eligible? Eligible employees are individuals who are employed in Canada. The employee must not have been without income for more than 14 consecutive days within the eligibility period. So, if the employee has gone without remuneration or compensation for 14 consecutive days, they would not qualify for the CEWS in the same period. So, how do I qualify? Well, first off, you would have had to have seen a drop in your revenue of 15 to 30% depending on the qualification period. Now, for the purposes of this act, revenue would be considered total sales during the period, not income or profits. So, if your profits have dropped by over 30% while your revenue remains the same, you would not qualify. Secondly, the decrease in revenues must be attributed directly to the COVID-19 crisis. And you must be consistent with the application of the qualification methods. So, what is the qualification period? Well, first of all, there's two benchmark options that are available. Number one, you can qualify by using a year-over-year method, which would be March 2019 to March 2020, April 19 to April 20, May 2019 to May 2020. Or for those businesses that are new starts, up and coming, or have only been in business for a little while, you can choose to use an average of your January, February gross revenues compared to March, April, and May. So how do you do that? You add your January and February revenues together, divide it by 2 to determine your base income, then compare that income to the income in March, income in April, and the income in May. Please note, once you choose a method, you need to maintain that method for the entire period and cannot change. So, what are your qualification periods? Well, the chart below will explain the qualification periods for you. The first application period would be for revenues that were affected in March of 2020, and that would be in comparison to March 2019 or using the January-February weighted average. If your reduction in revenue was 15% or greater for the period of March, then you would be eligible to claim a subsidy based off of paychecks that were sent out between the periods of March 15th and April 11th. The second period would be for your April, either year over year or compared to January, February average. You would need to see a 30% reduction in your total revenue, and that would be on paychecks or payroll periods of April 12th to May 9th. The last one being for May, again, May year over year, or using the January, February average. Again, it's a reduction of 30%, and that would be for your payrolls between May 10th and June 6th. So let's look at our accounting methods to determine how we calculate our revenues. There's two options, the first one being the cash option. When you use the cash method for accounting, you report the income in the period where you receive payment for the services. Remember, when you're using a cash method, any accounts receivable that may have been outstanding from December, January, February, if received in the months of March, April, or May, would be considered income during those periods if you use the cash method. Under the accrual method, you report the income when you invoice it or when you earn it, regardless of when you receive the cash. So if you do a job today and you invoice out your client and you don't receive payment until June or July, you would report that income now versus June or July. So the federal government's actually been able to give us a couple of different ways that we can qualify for the CEWS. But I must warn you, you have to be consistent in your method. Make sure that once you select how to calculate your revenues, you're going to use the same method. So either use year over year or the January, February average, but don't mix them. If you're looking at the accounting methods, either use the cash method or the accrual method. Again, the cash method means that if you have any accounts receivable from December, January, or February that have been received during March, April, or May, that would be considered revenue for the March, April, or May periods. Most importantly, once you select a method, don't flip-flop. Pick a method and keep it. Okay, so now we've taken a look at the qualifications. We've decided which method we're using. We've taken a look. We've looked at our records, and we know that we've qualified for the CEWS, and we're ready to make our application. Well, what are we entitled to? We're entitled to 75% of what wages are included under the CEWS. First of all, let's take a look. Wages include normal salaries, wages, commissions, bonuses, and most taxable benefits that would normally be provided to the employee pre-crisis or was provided to them before March 15, 2020. There are exclusions, however. Any money that you would pay out as a severance package, stock options, and the use of an employer's corporate vehicles would be excluded from the 75% calculation. As well, just because there's a 75% calculation, it's not a time to issue raises, bonuses, other than what would normally be paid in the result of a business if you have a normal contract. Well, that sounds easy, but just when you thought the hardest part was determining if you qualify, we're now going to talk about the 3 different ways to claim your rebate. For existing employees, we have 2 options: 75% of 100% of their wages up to a maximum, or 100% of the first 75% of their wages. And for new employees, we have 75% of 100%. So, to better understand this, let's check on our 2 new employees, Roxanne and Wiley. So, for existing employees, we're going to talk about 75% of 100% or 100% of the first 75%. In order to do this, let's meet Roxanne. Roxanne has been a long-time employee with us, and she earns $57,200 a year or $1,100 a week. Due to COVID-19 and the decrease in business, Roxanne was or is facing a layoff. Under normal circumstances, this would entitle her to, right now, $500 a week under the CERB benefits, or 55% of her normal wages for EI. That would be a total of $573 based off of her maximum EI, which equates to 52% of her salary. So, let's see how the CEWS can help out both Roxanne and her employer. In this situation, Roxanne's employer is an essential service. That means that Roxanne can continue to work, and she would receive 100% of her normal salary, wages, bonuses, and commissions. As for her employer, since they qualify for the CEWS, they can be reimbursed 75% of her wages up to a maximum of $847. Now, since Roxanne's wage is normally $1,100 a week, 75% of that is $825, which is what the employer would qualify for. But let's say that Roxanne's not so lucky, and the Acme bomb factory that she works at is closed down. Roxanne's employer has had some projects they've had on the books for a while, and thanks to the CEWS, they're able to give her the opportunity to work at home. Although Acme has limited to no cash flow, so they can offer Roxanne 75% of her normal salary, which would be $825 a week. Now, although Roxanne's pay is now reduced to 75% of what she used to make, she's still making $252 more than she would have if she would have been on EI, or $325 more than the CERB benefits. And if the employer was able to take advantage of some business loans that were made available to him, Roxanne would not even skip a paycheck. And for the Acme bomb factory, well, since they qualify for the CEWS and Roxanne was already employed by Acme prior to March 15th, Acme would receive 100% reimbursement of Roxanne's wages because the company did pay her 75% of her regular salary, and the amount of the credit was below the $857 maximum benefit. However, the intent of the CEWS is to keep employees' pay the same as what it was. So in cases where you're reducing the employee's pay, you must be careful to make sure that you're backing it up and showing that you're not trying to take advantage of employees. So, next, let's meet Wiley. Wiley is a new hire for the company. Due to COVID-19, Acme needed to hire a new employee to develop online tools to keep the company viable. Wiley is a student website developer who lost his job, which was paying him $65,000 a year or $1,250 a week. However, because Wiley needs some work, he's accepted a temporary position at $750 a week. As Wiley is a new employee, He only qualifies for 75% of the wages that he's paid, which means the company would receive 75% of the $750 or $562.50 per week for Wiley as a temporary employee. However, the company has known about Wiley for a while. So instead of them offering a temporary position, they first go out and say, okay, you know what, Wiley, we want to hire you permanently. We're going to offer you $1,129 per week, which means that the company would qualify for the maximum benefit of $847 for the 3-month period of time. Wiley, so happy to have found a permanent job, accepts the new position knowing that although the company is struggling and his wages are a little bit less, he's working for the type of employer who's going to look after their employees whenever they have the opportunity. This becomes a win-win situation for both Wiley and the Acme Bond Factory. Okay, now we're all set. We understand the rules. We understand where we're at. How do we apply? Well, applications can be made through the employer's My Business Account portal, and the Canada Revenue Agency is creating a new web-based application that will also be made available. However, remember, as of April 10, 2020, the Canadian Emergency Wage Subsidy program has not been enacted yet into law. So we will update this presentation once royal assent has been provided and give you more information as to how to apply. The next question that we get from some of our business partners is, how do we report these benefits when we receive them? Well, the Canadian Emergency Wage Subsidy is taxable to the recipients. So that means it should be reported on your financial statements as other income, but it would be exempt from the GST. Please make sure you talk to your tax professional for more information on how to report it. As part of the April 8, 2020 announcement, the government is also proposing to refund 100% of the employer's portion of CPP and EI. This benefit is available for all eligible employees for each week that they will be on leave with pay, that the company would normally qualify for the CEWS, and the employees do not perform any duties for that week. So if you're an employer who is shut down and would like to see their employees paid as much as possible, you could pay them 75 to 100% of their regular salaries. If they're not doing any work, the company would also be reimbursed for their CPP and EI. This benefit would be applied for at the same time as the CEWS and would not go through the payroll remittance process. Speaking of the payroll remittance process, what is the 10% wage subsidy and how does that affect the CEWS? Well, on March 25th, the COVID-19 Emergency Response Act received royal assent, and in that was included a 10% wage subsidy for all Canadian employers. It's a payroll remittance reduction of 10% of the wages that were paid from March 18th to June 19th for that 3-month period of time. Employers can reduce their monthly payroll remittances by 10% of their total wages during the eligibility period. The maximum deductions are $1,375 per employee or $2,500 per employer. Now, the subsidy is available to all small employers in Canada, regardless of whether they've lost revenue or not, and it is taxable as well. How do we coordinate it with the 10% wage subsidy? Well, first of all, if you're eligible for the CEWS, you'll need to reduce your 75% claim based on the amount claimed under the 10% wage subsidy. Now remember, the 10% wage subsidy is available as early as April 15th, so claim it now and reduce your CEWS later. Another question is, how does this affect my EI work sharing program? Well, if you're participating in the work sharing program, know first of all that it's been extended from 38 to 76 weeks. And for employees and employers who are participating in the EI work sharing program, the EI benefits received will be reduced when claiming the CEWS. Lastly, let's talk about compliance. If you're thinking this is a way to get yours, well, you better think again. Once the crisis is over, the Canada Revenue Agency will be auditing all these claims. So if you've applied in error, make sure that you pay the amounts back immediately. If you're caught, here are some of the penalties that you're looking at. You'll have to repay the amount that you received plus a 25% penalty if you've been caught adjusting income or creating artificial transactions for the purpose of claiming the CEWS. However, if the government thinks that the abuse was intentional, the penalties could be much larger, including jail time. So, I urge you to consider that the government has acted in an unprecedented manner with rolling out subsidies and programs in record time. Let's not take advantage of what they've done for us and show them the respect that they deserve. I want to thank you for tuning in. I'd also like to invite you to our next episode where we'll discuss the Canadian Emergency Business Account. Once again, my name is Stacey Bartel from O.B.S Financial and the wealthmanagementstore.com.